Hi, I'm Captain Steve Alberts, co-chair of your ALPA Negotiating Committee. Welcome back to True North, our Contract 2020 education series. In this installment, we will cover disability plans with a focus on long-term disability coverage. You'll see how these plans work and get a look at how our current plan compares to the plans covering pilots at our peer carriers, both in terms of plan design and how the plans are funded. Long-term disability benefits are designed to provide payments after a certain period of time has elapsed, which often corresponds to the expiration of sick leave or short-term disability benefits. Long-term disability benefits are typically 100% company funded, although in some cases, buy-up options funded by the pilot are available. In some cases, the cost of company-paid coverage is imputed, meaning it's treated as taxable income to the pilot, but the benefit paid is tax-free. In other cases, the coverage is not imputed, in which case the disability benefit itself is taxable. The pilot's share of the cost, if any, is paid with after-tax dollars, so that portion of the resulting benefit is always tax-free. In the event of a disability, let's say a result of an illness, a surgical procedure following an accident, a long-term disability plan will typically provide replacement of 50 to 60% of monthly earnings, up to a maximum monthly amount. This amount is then typically offset by any disability benefits the employee may be receiving from other sources, such as workers' compensation, state disability, and/or Social Security. Other offsets may also apply, including wages for work performed while on disability. The definition of disability is very important. There are two basic definitions that may apply at different times. The first is own occupation disability, which is generally specified as the inability to perform the duties of the individual's own occupation. For pilots, this generally means being unable to exercise his or her medical certificate as a result of a disability. The second definition is any occupation disability, which is generally specified as the inability to perform any occupation for which the person may be qualified by training, experience, or education. Any occupation disability is typically a harder standard to meet than own occupation disability. Some pilot plans provide for own occupation disability all the way until age 65. Other pilot plans provide for an own occupation definition of disability for a period of time, typically for the first 24 months that benefits are payable, after which the any occupation definition applies. Plans that are funded through an insurance company rather than self-funded by the company tend to fall into this second category. So what would happen if you became disabled under the current Kalitta Air plan? Our plan provides own occupation coverage for 12 months, after which the coverage changes to any occupation coverage. For the first 12 months, you would be paid 60% of your monthly guarantee, up to a maximum of $10,000 per month, as long as you were unable to perform your own occupation. After those 12 months, if the insurer determines you are able to perform any occupation, your long-term disability payments will be terminated. If you're determined to be unable to perform any occupation, your disability payments would continue until your Social Security retirement age. The cost of the Kalitta Air long-term disability plan is paid 100% by you, the pilot. The benefit is tax-free since you pay with after-tax dollars. So how does our plan stack up against our peers' plans? Let's first look at who pays for the coverage. At Alaska, Delta, FedEx, Frontier, and Hawaiian, the company pays 100% of the cost of their pilots' long-term disability coverage. At Spirit and JetBlue, the company pays 100% of the cost of the core plan, and the pilots have the option to pay for a buy-up. United pilots share the cost of coverage, with the company paying 65% of the cost. Imputing of income for the company-funded portion varies by carrier. Kalitta pilots pay 100% of the costs. The long-term disability plans covering our peers at Alaska, Delta, FedEx, Hawaiian, Spirit, JetBlue, and United apply the own occupation definition of disability until age 65, or Social Security retirement age. The Frontier Pilots Plan, like most insured long-term disability plans, provides coverage under the own occupation definition of disability for 2 years. Under the Kalitta plan, the own occupation definition only applies for 1 year. After that, benefits terminate if a pilot is able to perform another occupation. As you can see, income replacement percentages are similar, but maximum monthly benefits payable vary across our peer carriers, ranging from $8,000 on the low end at Frontier and United to no stated monthly maximum at Alaska and Delta. In light of this disparity, we're making it a priority to improve the way in which our plan is funded and to enhance the benefit itself. In our next True North edition, we'll talk about short-term disability plans and how our plan compares to our peers' plans. Be on the lookout for that installment soon. Remember, you can always reach us at cksnegotiating@alpa.org with any questions or comments on bargaining. I'm Captain Steve Alberts. Thanks for watching. Fly safe.